Good morning, wizards. So are we about to see a massive bull run about to happen in the cryptocurrency arena? That's what I want to talk about and answer in this video. So are cryptocurrency prices about to skyrocket? Is it going to happen because we're seeing a falling wedge chart pattern happening right now? So the first thing I want to say is I found this post by Galaxy BTC on Twitter. Now I'm new to Twitter. It was recommended by one of the wizards here on the channel that I get on there. So I went on Twitter and I saw this post and I thought it was really interesting. The post basically says that there's a falling wedge formation happening right now with the market cap. And does that mean that we're going to see a bull run? Is there a 68% chance that's going to happen? So the first thing I need to say is I don't believe that looking at chart patterns is a very good way to predict what's going to happen in the future. But a lot of you who already follow this channel are going to be surprised to know that I do think there is some validity to this post. See, it wasn't studying financial markets at the London School of Business and Finance or attending lots of seminars or reading lots of books that taught me about what works and what doesn't work in trading. What taught me what works and what doesn't work is losing a ton of money. So since I was 17 years old, I'm now 33, since I was 17 years old, I loved trading and I learned everything I could, only to realize that most of the material put out there for the stock market traders is designed to help you to lose money. See, investment banks like Goldman Sachs, when they file their SEC report, the 10K report, with the SEC every year, around 95% of the days out of the year they're profitable, which is the same ratio of retail traders that lose money. Now, I do think a lot of those traders have come into crypto and they've been teaching about chart patterns, etc. They've had some success in crypto because actually I think trading in crypto is the best place to learn to trade. However, I don't think there's a lot of validity to just relying on chart patterns. But like I said, I do think there is some validity to this. So what I want to do is actually deep dive a little bit more into how to use chart patterns in a way where they do make sense. So the first thing we need to really think about is context. Let's talk about the context of the market. You see, if you go to trade in a prop firm, the first thing they're going to do is to get you to trade the order book. Only then when you're profitable can you start looking at charts for context. So prices on a chart tell you what's happened. It's like looking in the rear view mirror of your car. Where have I just come from? And that can actually be quite useful in the overall scheme of things. That said, what's the context of what's happened in the crypto market? Well, we saw this massive spike up in prices in December last year, and then this massive crash. Well, why was that? There was a whole fear of missing out. It was driven by hype, by speculation, and by greed. And that greed, the gap between the fundamentals like the network effects, like Metcalfe's law, etc., the gap between what that said the prices should be and where the prices actually were, that gap is called greed. A lot of hype that was also pumping prices up got sucked out of the market because Facebook refused to allow those adverts to continue coming out. And a lot of these ICOs and cryptos were pumping their coin through Facebook advertising. And of course, there was a lot more that came into the crash. But overall, the general context for me is that we had a bubble. I'd like to tell you about another bubble that became extraordinarily successful. And I believe the same thing is going to happen here with crypto. So when looking at the dot-com bubble, we can see that a lot of people came rushing in to buy stocks. People were saying, hey, what is website? What is internet? But they were buying the stocks nonetheless because it was as though money was going to rain from the sky. Does that sound familiar to you? But what I want to talk about is what happened after the crash of the dot-com. You see, if we scroll along till today, we see this nice sort of cup pattern happening here, this kind of pattern. And then where are prices right now? Well, bang, they're all the way, let me just get rid of that. They're all the way up here. Well, I would say that prices went up because the Googles, Amazons, and Microsofts of this world took over. Websites took over. They made doing things cheaper, faster, better. They made the cash bag bigger and they added value. So my guess is the same kind of cup pattern that we saw here with the dot-com bubble is very much likely to happen with crypto. So we're going to see some runs up. We're going to see some value coming in. You'll see with some of the videos I've just posted, real value, billions of dollars being saved in industries. It's happening. I also believe, and you would have to believe this as well if you want to speculate that prices are ever going to go up again. You'd have to believe this, and that is that economies are going to be tokenized. By owning those tokens, you own a stake in that economy. So if you believe that's what's going to happen, that's also what's going to drive the cryptocurrency prices to go up. You see, there are companies deploying blockchain that don't have a crypto price attached to them. They're going to make that company on the stock market more profitable. That's not going to impact the coin market cap. If you want to invest in coins and you want the coin prices to go up, you need to believe that there's going to be more demand to own economies on the blockchain through tokenizations. That's what you need to believe. That's rule number one. Rule number two, we want to talk about volume. Don't read price without looking at what's going on with volume. If we take a look at our Twitter post over here, something very interesting is going on. You can see the volume spike here, even though it's sell volume. Even though it's red, you can see that volume is high, but price is going down. Now, this is called a divergence, and we can see it here on the total market cap chart as well. Let me just get rid of this. We can see the same thing happening here on the total market cap chart. Price going down, yet volume going up. Now, the exact opposite happened where on this channel, we called the market top. We called it the day before it happened. Literally the day before, where we posted a video saying, hey, guys, prices are skyrocketing and volume's going down. That's called a divergence. That means that very, very likely we've exhausted buyers in the market. And so prices were going to go down, and that's what happened. I'm not a genius. I can't predict the future. But what I can do is look at price and volume in a way that tells me something's off, something's wrong. We've either exhausted buyers or we've exhausted sellers. Now, down here, we can see prices dropping. Is that because we're shaking off the last of the sellers? That's how we need to think about these chart patterns. What's happening in the overall context and what should actually drive the price to go up? Have we exhausted the sellers and are buyers going to come in to eat up the order book to push price up? So finally, rule number three, I want to talk about using leading indicators rather than lagging indicators. So lagging indicators where you're just looking at chart patterns, again, it's like looking in the rear view mirror of your car. But now how do you see out the window to see what's coming up? And that's the real secret over here. So what I want to talk about is what are leading indicators that you can use. So first of all, there's the data-driven approach. So two very important leading indicators from a data-driven approach. Number one, what are the fundamental data principles telling us? So here we're talking about network effects. Metcalfe's law, again, go back and watch my previous video on that. It's really, really helpful here. What does Metcalfe's law say? Because we know the value of a network is directly proportional to the number of users in that network squared, give or take. So what is happening with the value of the market right now compared to how much usage of the market, of the underlying technology is happening? So that's number one. Number two is market sentiment. So I believe that market sentiment will drive between 10 to 40% of price movement, and Metcalfe's law and the network effects and those fundamental principles are going to drive the remainder, sometimes 90%, sometimes 60%, depending on FOMO and greed. But I did want to leave you with just this final point, which is why should prices go up right now? What reason does anyone anywhere have in order to acquire crypto? Now, when we talk about that cup and handle pattern we were discussing earlier, if we draw that up here again and we say this could happen with the market, we have to ask why. Like, where are these buyers actually going to come from to push prices up? So here's my theory on it. We know that Goldman Sachs has acquired Poloniex. We know that's happened. We also know that at some point, pension funds and insurance funds are going to want to own cryptocurrency. Why? Because it's an asset class, and by adding it to their portfolio, they actually lower the risk of that portfolio. Now, when the big money comes into this market because they want to buy the tokens that allow people to own economies, that own shares in a building or own processes on supply chain, whatever that economy is going to be, big companies are going to want to have a stake in that. And so they're not going to want to pay top dollar for that. They're going to want to come in slowly. They want blood on the streets like there is right now. And they're going to want to come in slowly. They're going to want to own these technologies for cheap, and they're not going to want anyone else getting those technologies at that price. They want to get there first. So I don't see them just dumping millions of dollars in one day and buying up crypto assets. Number one, they need real crypto assets that they can have confidence in, that they can buy up. Number one, that needs to happen. So you need to ask the question, do those exist today? I do believe some do exist today, but still a lot of the cryptos listed on CoinMarketCap are BS. Number two, they're really going to come in slowly. And that's why I see we would likely see over time this cup pattern, just like we did with the dot-coms. We saw real world businesses proving themselves and then big money coming in to acquire more of those real world businesses. I hope that you found this video very useful. If you want to become a friend, just subscribe. Until the next one, take care and talk soon.